Good morning everyone, welcome to the Euro Trade. I'm your host Marcus Stalker D. I have been trading for 19 years and I'm mainly a commodities trader. That means we're going to be focusing on precious metals and energies markets. So with that in mind, let's have a look at what we have in the options chain and the levels that I like to use. For those who are new here, I use a combination of market profile, statistical averages, and gamma exposure levels to find my areas of interest. I'm pretty stubborn when it comes to the levels that I look for, and therefore I do not do subpar setups. So if the market is not exactly at the level that I'm considering as a level of interest, usually somewhere where the dealers might hedge, I won't enter a trade. Alright, so yesterday I did do just one short silver trade right in the middle between 77 and 76. And didn't keep it for my usual sort of 100 minutes because I was wanting to have a bit of a day off after the stream. But that one worked, so it brings this whole experiment of scaling in and me practicing the scale-ins almost, well, over halfway for sure, but let's say about 60% to the target. This is what we're working with. Now, the full scale-in that I'm planning out is obviously not currently being used because the restrictions that we have on the metals because of the big volatility that we've experienced. However, looking across the board, we now have the implied volatility basically stable. The only one that is still falling is gold, and the copper and silver have largely fallen, but the implied volatility stayed the same. This is typically a sign of an orderly sell-off rather than any kind of panic selling, and that is something that we haven't seen in a while since this crazy volatility began. The area of interest that I'm looking at is GEX2. That's a pretty strong GEX gamma exposure level, meaning there's a number of open interest contracts there. When I look at the London value area for copper from yesterday, even though it was a holiday day, we still had quite a lot of trading going on, so the value areas do remain relevant. The value low is sitting all the way up at 76.80, so 576.80, that's somewhere around this area. And the mean reversion could be on the cards here, but it would need to reclaim VWAP. We are quite far away from the Asia low, which would be my next area to get involved. But at the moment, VWAP is the only thing that we have here. There are really no bigger notable open interest levels in the way to the value area. And the next bigger GEX level is sitting all the way up at 590. The rest of them are pretty small, so we effectively have all of this to work with. This is the statistical average. The 80-year high is sitting at 586 roughly, with a London average session range high, so we're just using the London levels, London ranges before COMEX open, to project how much statistical space we have. And that is sitting around the round number of 580. There is, again, no notable levels there. There is the end of day gamma flip, just under it, so around 579. But when I look at the open interest, that is not really enough. The whole gamma condition is positive gamma, which means that we are in a pretty stable environment, but also a mean reverting environment. Gamma condition is not a directional indicator. It is literally just telling us how the prices might behave, whether they're going to be a little bit more orderly or in the case of negative gamma, whether we're going to be in a bit of a crazy outlook and market just slicing and dicing through the levels as and when they appear before maybe reclaiming them. Not expecting that whilst we're in a positive gamma environment without some sort of an external catalyst. So that's what I'm looking at. We need to wait to see what happens around VWAP. Whether it happens now or much later, I really don't really bother with when it happens. But London session tends to be the quiet part of the day, especially since at this time of day we don't really have any major exchanges running that heavily focus on the metals. However, once we get to 11:40 a.m., right now it's basically 9:38 a.m. in England. At that point, when LME starts trading, we will see some increase in volumes. But at the moment, it is all trying to establish a range, which is a normal behavior for this time of day. Looking at silver, we still have a lot of levels that are smushed together. It's a similar situation as yesterday. I'm just going to put my Asia high and Asia low because that is the first session that does the price discovery, and they pretty much left the high at Globex open and then continue to move away from it, establishing another high between about 2 and 3 o'clock a.m. and then finally going all the way lower before the take profit move that happens after Tokyo close and into the final hour of Shanghai exchange. Again, statistically very normal behavior. Silver is currently rejecting VWAP from one of the call walls at 75, but really I don't have that much else at this point. So looking at gold, we do have two important price points, which is 4,900 and also 5,000. Nothing much in between. We have VWAP obviously because that's the alternate orientation point. So again, let's see whether we establish a range here, and then later on in the day perhaps we have a resolution of that. Crude oil and the energies markets are in rollover. The only one that has already rolled is RBOB, which is gasoline futures, heavily connected to crude oil. Why? Because it is a derivative product derived from refining crude oil, and therefore it is the more volatile twin of crude oil, as is heating oil, which not many people trade, but sometimes I do. However, RBOB is the only one that's rolled into the April contract, and until the same happens to crude oil, I will not be necessarily looking at crude oil levels because we need to see what the new contract is going to do. Right now, we're teasing the London value high. However, for the main session of NYMEX, we're sitting right under it. So these are the two markers. This is the fixed volume profile. What I do with that, I grab the fixed volume profile, then I find the time of day when NYMEX opens, and then I click and drag all the way to the end of the electronic trading times. Now, yesterday was a short day, so obviously we have a shortened time, but London hours are still the same, and this product can move quite significantly for the London hours as well. With all of that, let's have a look at the chat and who's joined us this morning. We have a G Trader saying D morning. Is D on or has the flu most of us? No, I'm on. I don't really get sick. One of the things with my chronic issues is that I have an overactive immune system, so it takes quite a while it causes other issues, it doesn't really make me get sick very often. And even when I do, my body tends to deal with it within like 2 or 3 days, maybe a bit of sniffles and stuff, but I literally haven't been properly sick since since April 2022. No, April 2021. Yeah, so that was when I had COVID last time, and I think since then I may have had like one cold, like a head cold, and that cleared up literally in 3 days. So no flu for D. I also don't go anywhere, so I'm very much still largely housebound apart from dog walks and an occasional grocery shop. So that also helps to keep viruses at bay. Hermit lady over here. AG Trader C says, D, I know you don't do NQ, but what about ES? Is that on your blacklist? If not, can we go over your analysis on it? So again, I'm not really much of an equities trader. If something happens with my major products and I just can't trade them, I will then default to ES and YM primarily. ES is not on my blacklist, but I think that the equities have gone into a much quieter period now. So I will have a look, but I didn't drag the options levels from the way that I do them. So the only thing I can do is maybe rely on the end of day mental Q levels just for a quick overview. And I mean, you know, even in at times of consolidation and potential downward skew, equities will still have buyers present. So in the end, they might not win the whole battle at the end of the week, but they're still very much present. So since we haven't looked at ES for a long time, let's have a look at the monthly chart first. Very range bound, right? I mean, some people will be like, oh yeah, but it's creating a bearish engulfing. You have to look at the context. Is the bearish engulfing coming from a nice clean run, or is it comprised inside a larger consolidation area? And I would say it's definitely comprised in the consolidation area. So very, very flat. I would say this is some kind of distribution, and again, we haven't seen this for a very, very long time. The last time this happened was in and about let's say December the previous year, and 2 years ago, and then January, February, March the previous year, last year. Let me start that again. So last time we saw consolidation was December 2 years ago, and January, February, and March a year ago. That's what I meant to say. Very early for me still. For some reason I woke up at like 6:30, and then I went back to sleep, and then I woke up even more tired, so I don't know what that's all about. When you look at how the ranges are doing, you will notice there's a compression of the overall monthly range. Could this be finally the time when equities go into a bit of a consolidating period, and maybe even some kind of a pullback? It's certainly possible, but I would say that the equities across the board at the moment have a bit of a downward skew to them. And until that's resolved, we have a context of 7,000 not being able to be broken. Every time they attempt to go over it, there are some people who step in, the wizards, and they bring it back down again. So until we have the resolution to the upside or the downside, breaking this whole consolidation downwards, I would default to more range-bound strategies without expecting some huge trend days on a daily basis. So equities are definitely going through a bit of a dry up in liquidity. Having a look at the weekly time frame, let me just delete some of these previous values so that they don't clutter up things and we don't need them. But as you can see, a lot of bracketing, a lot of overlaps of the overlaps of the overlaps. And again, this is the feature of the bracketing, aka ranging markets. In the profile concepts, they call that a bracket. Why? Is because the price is bracketing between a couple of points. So until that resolves, it's just a bracket, and we have to adapt our strategy. So this is not the weekly chart, pretty much the same thing, right? So a lot of inside bars upon inside bars upon inside bars. And every time somebody tries to do anything with it, the other party appears and brings it back into the middle of the range. So the middle should be kind of your loose profit target from this bird's eye view. So maybe mark off that with maybe some volume profile in a consolidation. That's generally a good way to approach it. Still deleting these latent value profiles. So let's see if we can maybe do the visible range profile, and then just have a look at the consolidation area. So I would argue that this was still a trend. So this is the bearish engulfing that started the consolidation range. In equities, bearish engulfings are not really that great for reversals because of the upside bias. But if something fundamentally changes, then you can absolutely use them as signals. And right now we have a point of control that is sitting at 69.4375. Kind of the middle of the range, a little bit higher than that. Again, it speaks to that upside bias that I'm talking about. And until that changes, until that POC shifts outside of the consolidation, I would be very careful with any sort of trending moves. But again, this is a bird's eye view, not really much to glean from it. We have a big demand area, we have a small supply area. Are they reactive? Yes. Can you use them intraday? No. But we use the tops and bottoms instead. So you want to mark those off, maybe put them in a screaming color so that you know what you're looking at. Give me a second. Frogs in the throat in the morning, as usual. And yeah, so mark off the high and the low of the range, and you can say this is weekly range high, also all-time high, and then weekly range low. And that should stay on your charts until the resolution. Let's have a look at the daily time frame. Yesterday was a holiday day, so this doji really means not much. Again, looking super messy, right? So we have a big bullish engulfing without much follow through that fails, and price is just pinging in an even tighter range, breaking the previous supports and resistances. So this was the previous support, it breaks it, bounces from it. Liquidity sweeps and breaks of the ranges low and high. That plays out on any time frame when you have a visible range. So again, supply and demand calls for trending markets, where you have a clear move away from the level that sustains the low and the high, and then effectively bounces from the nearest area of market shift point, which I call the conterminus line. You can see that sort of playing out here, even though it's a very messy demand again. But the price basically touches the market shift point. What's the market shift point? What is the conterminus line? It is an area where the market was in an equilibrium, in a consolidation, and then it breaks away from it. And then the nearest edge where the market shift point started is where the touch and a bounce is expected, right? But in ranges, what you expect is that the supplies will be broken. And again, you can immediately see that behavior start even in August, where they break the high, then completely reverse. But that demand still acts as a support, and then you have offspring demand that does the same thing before they carry on higher. So it already started back in August. I don't think that we've seen equities be so lackluster for a very, very long time. When I started trading in 2013 as a prompt trader, we had tight ranges. We had 20 ticks for the average daily range, but it had an upward skew because of the very aggressive quantitative easing. And this is where my dislike for equities comes from, because that held for like years. It wasn't like, oh yeah, just quantitative easing, bringing a bit of compression of volatility. No, we're talking like 7-8 years of just lackluster movements unless there were earnings. So I just couldn't be bothered with that. I prefer the sweet spot of around 200 to about 500 ticks average range before I get involved. That is just the method that I use, and something that has worked for me for an incredibly long period of time. But let's have a look at the 4-hour chart. 4-hour chart is a little bit more defined with some clearer moves, so we're starting to get a bit more of a zoomed in picture. So those buyers are still present, right? But look, so are the sellers. So I don't know, I don't really think that the equities are in a good spot right now, and they definitely have a downward skew on the larger time frame despite reaching all-time highs. But that 7,000 level still remains a pain point, and until we break it upside, I think we're going to see containment of price action in equities. So that's the overview of big overview of S&P. Some of the levels from the options, it's a very bunched up situation. So we have gamma exposure levels all the way from 68.30, then you have it at 68.25, then 68.20, and then again slightly lower 68.10, but then again 6800. It all literally means there's going to be a lot of push-pull between the dealers as the market kind of hedges in between those levels. Odie, yes, good morning. What is the difference between supply and demand zones and horizontal support and resistance? So it is based first and foremost on the assumption that you have a range. So let's default back to the weekly chart. So maybe a monthly because it's more pronounced there. Yeah, so on the monthly chart, the difference is the number of candles or time that something spends in a range. So from the traditional supply and demand, from the technical side, you really don't want more than about 6 candles on any relevant time frame. Ideally 4 or 5 maximum, but really 2 or 3 for a proper high quality supply and demand area. Whenever you see the market spending more than 4, 5, 6, 7, 8 candles, that is no longer a supply or demand, but it is rather the lack of interest. This is something that I talk about in the program, I think already in the first lecture, but certainly throughout the whole material. And it is a very important distinction between whether to use extreme high and low when you're suspecting a range, based on the fact that we spent so much time in this area, and we're talking about a monthly time frame, right? This is not trivial. This is like 1, 2, 3, 4, 5 months of the price action going absolutely nowhere. Do you look at the supply and demand? Maybe if we again break this either side, so if we go higher, it would be a reaccumulation. If we go lower to properly close below this 65.86 half level, then maybe we can go, okay, well maybe this is now a new supply. But how much time have we actually spent in the consolidation? That is the primary definition that I use to figure out whether I should be, using supply and demand, or just the ranges. Similar thing goes for intraday. Intraday generally likes to take out highs and lows, so supply and demand on low time frames, as you might have been taught by, supply and demand original teachers. It's not going to work in the same way, and it's actually better to look for those liquidity sweeps more as a default on intraday. So anything below 4 hours is considered an intraday time frame. I would also argue that it is 4 hours is also an intraday time frame, but yeah, generally Asia high, Asia low could be support and resistance rather than supply and demand, and we do expect those levels to break through. But it is time, right? So how much time do we spend before ungluing ourselves from the area? This weekly time frame tells us that we're not even leaving the consolidation, okay? So the jump outside of the consolidation would be if one whole candle actually opens and closes outside of it. As long as one part of the bar keeps popping into the form of or assumed supply or demand, that is still contained in there. But as soon as you get a candle that will open and close outside of it and then has follow through, then you can start to anticipate the creation of a good quality supply and demand. But time is something that not many people talk about. I talk about time a lot. It is my primary way of figuring out whether there is interest or not at the level, and also whether there is enough follow through, enough juice to take the prices elsewhere. I don't think so yet. So until that changes, we make the distinction between a range using extreme highs and lows and supply and demand using those market shift points. The highest quality demands don't spend a lot of time when they're being created, right? So 3 to 4 bars is really the maximum for a high quality demand. So we have, let's say that we have about 4 here before we get that final jump away. So here is where the prices started creating the equilibrium. These are the 2 candles. So where was the market shift point? Well, it's right here. Why? Because this candle stuttered, right? It was a stutter. It stopped the rise, and then we started to chop in a range. What is the first candle that leaves this range? It's this one here. And then it goes into a little base rally and continues. So this would be a higher quality demand. Now this is a weekly time frame. We cannot trade intraday from those, but they're generally very, very good indicators of direction. And then what we do, or what I do, I zoom in to lower time frames and then look for evidence of the market doing that. But there is a diminishing return, that if something already moved so far, like yesterday or something, then even if we are away from this level, there could be a chance for a mean reversion pullback intraday. That is where the can of worms of being an intraday trader lies, right? You have to be very good at figuring out whether we are due for a mean reversion, whether the trending move away from the level is still on the cards, or whether we moved a little bit too high, too far, and then you can maybe capture some of these pullbacks intraday. You wouldn't, like, once we've moved away and we get to 1, 2, 3, 4 candles that kind of made a push in the same direction, even though this one was a stutter. Is it still prudent to keep going higher? No. So at that point you need to be like, okay, let me look at the lower time frames and see whether I can get maybe some kind of a pullback intraday. So both longs and shorts are on the cards for us intraday traders. So you cannot be super biased on just one side and have blinkers like horses and just go, I'm going to be long today, because that is not a good way to develop situational awareness. So hopefully that description clarifies a little bit. Range versus true supply and demand is a matter of time spent at the level. But it's a very good question. Gold. I I don't see the rally, guys. What time frame are you looking at? Like, whenever people are like, gold is rallying! And I'm like, you're looking at a 5-minute chart or something, aren't you? Alright, so let's have a look at the 30-minute time frame. Like, it rallied at like 5:30, 6 o'clock, as a Shanghai post-Tokyo take profit move, for sure. This is not a rally yet. Like, it might be a rally if we can actually tackle this low volume area node, and if we go above 49.52.6, but this is still a range. So until they actually break to the upside, still a range. But if you're staring at the low time frames, and I mean, even on a 5-minute chart, this is, chat, you're funny, man, you're funny. I mean, what are you looking at? 2 minutes is maybe where you saw a push higher. So I'm gonna say to Chad, get off the 1 minute, mate, because that's what gets you into trouble. That's what gets you into trouble, and you're calling a rally on super low time frames, while the guy is on a 30-minute time frame, which is, you know, a very, very important time frame intraday. I don't know whether you were here when Hogue was talking, but we got a question of why do we like the 30 minutes so much? Because both me and Hogue, and you know, Coach Vince, everybody is banging on about a 30-minute time frame. Why? Because here's why. There are institutional traders with very big size that will only initiate their trades at a 30-minute interval. Why? Because their idea is to gain an average price across the entire day, wherever that price is. So whatever happens, they instruct the broker to say, hey, execute 1,000 contracts on ES every 30 minutes, or on gold every 30 minutes, because throughout the day, throughout the regular trading hours, or any hours really, I want to get the average price on the day. So this is why if you are trying to decide the state of the market, it's not good to neglect. Like, you can absolutely front run trades on lower time frames, but until the 30 minutes shows a proper push, it's generally not a great idea to start looking at super low time frames and then calling rallies. Like, do we have a rally from the beginning of the end of Tokyo? Yes. Is that something that sustains into this hour? Typically not. Some days, sure, anything can happen, right? But on most occasions, we actually see the market completely establish a range and pretty much go dead until LME opens, and most importantly until COMEX opens, because LME doesn't necessarily make a big impact with volume, because precious metals are no longer traded on that exchange. Where can I increase the thickness? Okay, here we go. So we're now hitting VWAP. Now VWAP across the board is a very important measure, because it is kind of like a moving average, but better because it has a volume component inside it, and that is why you see it being used for various settlement prices. You know, even LME uses it, and LBMA uses it to go into the pricing determination on copper. And if you didn't know, NQ and ES, for their settlement price, they actually use the VWAP created between 14 and 15 minutes after the market closed. That is their official settlement price. But of course, before then, we have the actual electronic trading close, and a Topstep that is designed to it's the exchange, the end of the exchange, but that's not the price. It's the end of day price. The settlement price in Equities is actually determined by the VWAP 14 minutes after the close. And then you have another hour where, you know, you can keep trading on you know, certain brokerages, but it's not considered settlement. It's just like the final hour of the day where people are closing out positions, and they are given a chance to exit positions post market close. But if I was going to do anything with gold here, I would say that this was the range that we were working with at the moment, and then you can already see that we went past it, and then reversed. What do we have? VWAP as an orientation point. We have a very thick volume here and some low volume, which is a single print from this smash down. It is a weak structure. So look, at some point in the day, we may go through this because it is a weak structure. But right now, we're kind of having trouble around VWAP. So I wouldn't be going, gold is rallying, let's go long, because my longs should be around 49.22 if I'm going to do a range trade. Because that's where we kind of stuttered, and that's where we've been rotating. So until that changes, it's a range trade, right? But yeah, so let's hold the FOMO for a second there, because it's the wrong time of day for metals to be rallying. If anything, silver and gold have now diverged, so there could be some kind of a spread there happening because they have been very correlated recently. There is a thing called the silver, the gold to silver ratio, GTR spread, as it's known in the industry, and that's when you see the divergence and you have to measure the spread. You can't just go, I'm just going to go long silver, short gold to get the spread difference. Surprisingly, Topstep does allow hedging between separate instruments, but they do not allow hedging on the same instrument. However, the spread trades are really not intraday. Spread trades usually take a long time to get back into unison, especially on these products. But you can observe that. You can measure the spread. And usually those are parts of co-integration strategies, and they bank on a basket of instruments, minimal two, to actually take advantage of the spread. You also have the crack spread, which sounds hilarious, but it is a real thing. And it's a spread in a very particular ratio between, and also it's not, oh, go one silver and one gold. You have to know the difference of volatility between these two products so that you can actually size up on one and size down on the other. So whichever one is moving less, that needs to be bigger size, and it needs to be determined mathematically, not just like, oh, I'm just gonna long this and short that. And this is why most of us who have been in the industry for so long, when we see people trying to hedge the same instrument, I'm like, first of all, what the hell are you doing? Second of all, that is not how you hedge, right? You cannot just do, oh, I'm just going to do one NQ here and another NQ there and just call it a day. It doesn't work. It's basically trying to game the system, right? So it is a pet peeve of mine when people try and do that. And, we're seeing people trying to take advantage of multiple accounts that are doing that. So it's like, oh, well, I'll blow up like 2x a phase, but then one of them is going to do great. Like, you don't want to be doing that. Find a proper strategy, If you want to do spread trading, that's entirely different, and you don't do it on the same instrument. So, research it, develop a strategy around it, and then, you're absolutely allowed to do that across different products that are correlated. So, like I said, crude oil, RBOB, heating oil, they're part of the crack spread. Silver and gold are part of the GTR ratio, gold to silver ratio spread. So, there are strategies around that. And then, of course, you have the commercial users and producers that use the futures to do one thing, and then they hedge with an option. That's definitely a big play. But they're doing that to protect the highest price or to protect themselves against the fluctuation in pricing in the case of a forward cash sale. So, you might be a factory, let's say you're producing a heating element and you want to use copper, right? So they have to, if they're running their business properly, they get a lot of cash up front, but then they might be underwater if they don't hedge and yet something happens to the copper price and it basically goes completely massively down, like we've seen recently. And they will use a variety of vehicles, financial vehicles, usually a combination of an options trade and an outright futures trade to hedge their actual sale, forward cash sale, right? So that's the role of hedging to protect something and not necessarily to speculate. And again, you can speculate, just not on the same product, and spreads typically take a long time to come back into alignment. And one leg of the spread will almost always be a loser, but the other one should account for it because of the difference in the volatility between the two products. So that's your hedging lecture today. Let's move on. Can there be two accounts in the same household? Unfortunately, I do believe that is against the rules, but again, don't quote me on that. Go look at the terms and conditions. Last time I looked, they weren't very happy if you have two people in the same household for the same reason. One person can go short, the other person can go long, and they are talking together, and then one person profits, one account profits, the other one doesn't. And how are you going to prove that it's genuine profits and that you weren't in cahoots with the other person? It's a tricky situation. So ideally, no, if you and your brother are living in the same house, that will be considered breaking the terms and conditions, I think. Again, that used to be the case. The rules may have changed, but it's generally frowned upon if you have two accounts in the same household. I don't have that problem. My husband works in banking, but he's not a trader, so we will never have that problem because he won't be with Topstep. Do you think silver would come back down? I don't know. I don't really have a crystal ball. All I can tell you is that silver at the moment, there is a weak call wall at 7,300, right above Asia high, right? But we also have a bunch of levels in the way. It's literally the same levels as yesterday. So it's 75, 75, 75, 76, and then we have Asia high from the price discovery during Asia, then 77. So it looks messy, right? Is silver going to come back down? It remains to be seen, right? I would argue that it's already down quite a bit, actually. So wouldn't you say that if we are still having supply issues, that we are down enough, and then actually there should be some sort of reversion back up? We are 50%, 48% from the high, obviously because of increased volatility. So to me, this would be another time where, I don't know, I might buy another 5 grand's worth of silver bars, personally. Just looking at, 10, 15, 20 year projection. Do I want to own more silver? So I have some from 45 and I have some from 71.50. Is this low enough in the historical view of silver falling short and AI still being a big venture that everybody's fighting over, for me to warrant that anything sub 100 is a good price point? I would say yes. So for me, just looking at it from a very long-term perspective, I would not want to, certainly wouldn't look for more shorts in silver, We're already seeing signs that whenever we reach 72 and whenever we reach basically below that 73 level, somebody comes in to buy it. And we're low enough to warrant some sort of a correction at the very least to the upside. So personally, just looking at that, I don't think more shorts would be a good answer. However, it's down to market generated information. Right now, we're still fighting the 75 level. If we spend the entire day not being able to reclaim 75, then yes, more shorts. But at the moment, it's too early in the day. Whenever I'm doing my options trades or any kind of buying and purchasing of trades that should go on for like years or at least for like a few months, like more position style trading, I never buy at the beginning of the day. I always buy at the end of the day. So do with that what you will, but I find that especially from like big sell-off days and weeks, you should always concentrate, or I always concentrate on getting the move that is already at the end of the day. So, you know, people have decided and they have already taken profits. So that's when I strike, right? That goes for my options trades, it goes for my swing trades, it goes for my position trading. When I was only a swing trader, I never traded in the morning. This was like the first 5 years. So from like 2007, when I started taking it seriously, all the way till 2012, all of my swing trades were done in the afternoon and towards the sort of the last 3 hours of the session. And that would be enough of a movement, counter trend movement in Asia to give me some space between my entry and what the Asia does, which typically go the opposite way of whatever the day is done. And then I would have enough space for my entry to handle yet another pullback or move in the same direction that would take it even further away for London. By the time that the new session came the next day, we would already be quite far away from it. But obviously on swing trading, you have to be really careful where the positioning is. So chart location becomes very, very important. I'm going to go back to RBOB because I'm kind of tracking it here from the bounce of that London value high, while keeping in mind, and I think I'm going to be focusing more on RBOB today than anything else. Why? Because I think it's in an interesting spot. It rolled first. We're currently inside value, but if we manage to get above value, so somewhere 215, really the next major area would be ADR high at ballpark just underneath 218, which gives me a pretty good profit margin, but I do need to wait until we're closer to the open, because whenever we run away to the upside, what I actually do intraday is to short RBOB and then look for longs later in the day. Because the runaway train to the upside on a short biased market is not a bad idea, especially if you look at what we have on the weekly time frame. And again, there's that range that I'm talking about across the board, really. Let me just block out the volume profile visible range. So if you have a look at how this market is behaving on a weekly time frame, you will see that we have a very, very clean range, relatively clean range. We went all the way up to this previous range and wicked it, so liquidity grab supreme from a weekly chart, and then back into the range. So now we're looking at a bearish engulfing with a massive selling wick. But this is a short biased product. So whenever I see that it runs away, especially if we can tag this conterminous line, the market point shift at 217, which just so happens to be very close to the ADR high on the day, that actually represents a high probability opportunity that looks good intraday and the weekly time frame in light of whatever is going on here. So that is situational awareness that took me a decade to develop. But it is a high probability opportunity for me. So therefore I want to try and short this if we ever get there. If we don't get there, that's fine. No biggie. I may catch it a little bit to the downside as an opportunistic short. But if I don't see any evidence of the short during that pre-market time when that trade is pretty important, I will be then waiting for much later in the day, closer to the Euro close and right after, so the London close happens, and then I might try and strike. If there's still no evidence of a good setup, I will then still wait for yet another 3 hours or 2 hours after that for the NYMEX settlement close and into it, when I have another high probability setup. So, you know, time of day is a huge component in what I do. It basically structures my day. It doesn't make me sit here all day hoping for a setup to come in whenever. It is a huge structure to my day. And for each of the products, they have slightly different timings to them, but it's always based on a similar structure of hedging into settlement of some sort. rather than battling the open. That's not my gig at all. In fact, I go do something else. I usually schedule a dog walk when I'm supposed to watch the open. So I don't watch the open. I just come an hour later and I'm like, right, what will the euro close give us? So I intentionally miss the first move. The only time I wouldn't miss it is if we have some really nice mean reversion. So let's play the devil's advocate here. And let's say that today we're opening NYMEX somewhere up in this area. That would still mean that I'm expecting a reversal from the conterminous line of a supply, but it would mean that now we're looking at a mean reversion down to value high because you're opening outside of value. However, Asia has not moved it far enough, and right now we're sitting right inside value. So the mean reversion in that respect that would come earlier and would typically come in the first hour during the initial balance, that is not on the cards today. So yeah, 218, point of interest, or 217.65, if we want to be really nitpicky. The dark one says, I know Doom and his wife both have accounts. Yeah, I don't know. They could have changed it. You know, we've had a lot of couples and, you know, husband-wife people. So maybe they changed that. Maybe they changed that. I don't know. But it used to be that you can't have two accounts in the same household. Again, read the terms. You know, I'm just like you. I'm another trader. I'm a bit more visible, but you know, I don't sit in meetings and stuff, so I don't know when they're going to change the rules. You know. So yeah, maybe they've adapted that. Maybe now they allow it. I don't know. Maybe you have to sign some kind of a disclaimer, additional disclaimer, and then you can do it. Do I trade trend lines? No. I'm an order flow trader. I read tape and I use gamma exposure levels. I look at everything in a horizontal way, not a vertical way, which is a trend lines thing. I don't find trend lines useful. I think they're wishy-washy. I think they are very sort of... Let's just say that they can be useful if you're looking at longer term moves. Like if you're just a position trader and you want to find a rough position where timing and accuracy is not a thing, yeah, they can work very well. But for me, I moved away from trend lines probably in about 2010. I used to match them with supply and demand areas. So let me see if I can maybe illustrate that somewhere. Just trying to think. Maybe, let's see, crude oil. Maybe that might provide something. So let's say that we're looking at the daily chart and you're maybe looking to go long on crude oil. So then you make sure that the trend line here, that the trend line has 3 touches before you qualify it. I mean, that could be qualified as 3 touches, right? So 1, 2, 3, more than 3 touches. And then you will be looking to, if you're looking for a continuation, then your level of interest would have been this one and this one. Upon the break of it, obviously you're looking for a change of market state. But for me, let's say that I want to buy crude oil when it comes back to this area. So what I will be doing is matching any kind of a trend line with a demand level. So if I'm looking at something like this, then maybe if we're going down, let's now imagine that we have a downward trend. So we start going down and I'll be like, okay, so when does the trend line intersect my next area of interest? You can also have slower, less sloping trend lines that might actually create a demand area as the price weaves up and down, and in that case I'll be looking for a pullback to that trend line, but this one was pretty sharp, so here you'll be looking for a break of it. So I have used them in the past, as you can see. However, I just find them not really that valuable anymore, and I chucked out a lot of stuff that I did not find was useful and was just cluttering up the chart. In the end, I just went completely down the order flow, major supply and demand horizontally, support and resistances in case of ranges, so extreme highs and lows, statistical averages, which is again kind of a volatility band, but projected statistically based on the actual movement of that product rather than just guessing where the trend line is going to end. But, you know, if they help you, just continue to use them. That's absolutely fine. Like I said, I found them helpful in the beginning of my journey, but you're looking at, you know, nearly 20 years of doing this. And over the years, I just thought they were cluttering up the decision making. So I chucked them out the window, and I use GEX levels for intraday orientation. I use VWAP because it's volume component based instead of the regular moving average. And I use statistical averages. So everything else is a matter of time of day and where the dealers are going to hedge. Those are, you know, the things that move the markets. So, you know, me going back to trend lines would be, I don't know, me being confused, I suppose. So yeah, tape, bookmap, GEX, market profile, and statistical averages. So no need for trend lines for me personally. But again, we're all different. We're all different. If it helps your situational awareness, keep using it, right? If a regular moving average helps you, keep using it. You know, there's nothing wrong with that. It's just that, you know, once you go order flow, you tend not to go back to slightly laggy trend lines and indicators. I actually got a lot of stick. Like recently, I mentioned it earlier, that my video from like years ago, which was a short, it basically suddenly started getting more traction. I don't know why, but basically I'm talking about why I stopped using MACD, RSI, and all of that. And to me, again, they're not useful at all. And I always like to have a little bit of humor attached to it. So, you know, I'm being a bit cheeky in the video, but it wasn't like, oh, I know better. I was literally just talking about what I find useful and then adding some humor to it. People seem to find that offensive. Like, I can't believe how much offense people take to, like, just like simple jokes. It's like, guys, I was a daughter of a musician comedian. I grew up with humor. So it's like, I'm sorry if I want to crack a joke about me not using RSI. It's like, damn, dude. And then a few people were like, oh, but I still find them useful. Maybe you're not using them properly. And I'm like, what are you talking about? It's like, I don't want to use them because I use Orderflow. Sorry, my dogs are screaming. I'm just going to mute them for a second. Alright, so I initially shut my dogs in the bedroom with my husband who was still asleep, but he got up and now he's awake, so he let all the dogs out and it was like, we're awake! Oh, and Maria's in chat, totally agrees on the trendline thing. Yeah, they're useful, but in the right context. Gear says, a good point actually. Topstep own software will compensate for the bug issues, but that is a big advantage over anyone else, and they all do not have this. Yeah. Flash Golden says, dogs arguing the PA analysis. Yeah. Like, we disagree, buy it now! Because they're like the ultimate FOMO creatures, right? Whenever one of my dogs goes out, at least 3 of them have to join, even though they don't need to do their business. They're like, oh, we need to go and sniff. Like, what have we missed? And the doggy daycare decided to split them into two sets of 4. Because whenever they were trying to train the others, they have a very strong bond, right? And they do get along with other dogs just fine. But whenever they were trying to train the other 4 in a different area of dog daycare, the 4 that were left with another carer were like, what are you guys doing? And they kept trying to like see what the others are doing. So they are pretty sweet. All right, so as predicted here, GC has yet again wicked above and then went below the VWAP. So this is definitely still that range that I was talking about. Silver is starting to have a little bit more correlation now with gold. That was not the case. So yeah. Yeah, Elvis says, good morning, D. I see that you're, see the YT mob found your YT short. Yeah, exactly. Yeah. The YT mob is right. I mean, Jesus Christ. Like, all I'm trying to do is, you know, provide value. And in the shorts, because I hate shorts. I'm an older woman. I grew up with long form videos and doing courses and, you know, going through university degrees and stuff. To now have people learning such an important skill like trading, which is very difficult to achieve to a very high standard, especially intraday, trying to learn that on like short YouTube bits, it's like just laughable to me. I'm sorry, but it is. And then I tried to put humor in it because I do think that shorts are ridiculous. So I will provide some value, but it will also crack a joke and make fun of something in the video. You know, I made fun of prop firms changing rules. It's across the board, right? It's just how the industry is. It doesn't mean that, oh yeah, I'm laughing at them. No, it's just how it is. But, you know, it does give me some fuel for the comic relief, you know. And then I also say, you know, if we do find that you are a consistent trader, you will be assimilated. We will send Borg to assimilate you. And then tell others so they can be assimilated in our midst as well. So, you know, it's all just lighthearted. You know, don't take it too harsh just because I don't use something that you use. Just remember, we're different people. It is absolutely fine that you're using something that I don't. I have no problem with that. Absolutely none. And I'm sorry if anybody thinks that I do, but it's just humor, guys. Like, it's really not that serious. Man, people are just so offended. I can't say anything anymore. You know, people are just offended at everything. And remember, I'm Generation X. We don't care. We don't get offended. You can like come up and tell us you're the ugliest person I've ever seen in the world. You look ridiculous. And we'll be like, you're right, man. Cool. You look ridiculous too. And these days, if you do that, and you try and crack a joke, the other side, somebody's going to punch you or sue you or something. Like, Jesus, come on. Really? So yeah, the world has gone a little bit too I don't even know what to call it. What do I call it? And this is Granny D complaining about the state of the new generations. So making me sound 100 years old. Cheers. While I drink my tea, living on the edge over here. Right, Chris says, I don't care, everybody's complaining about all these random issues. This is still way better than funding my own accounts, which I did previous 6 years in crypto. I love prop firms now. Exactly, yeah. Again, I see people who are, I see people who say, who say, oh, you're better off trading your own money. Really? Really, because let me explain to you how that works. First of all, you can't really start with just the day trading margin being put up in your actual account, right? So you still need to put up the initial margin requirement. And this is something that people don't understand. It's like, do you not know how things work? So when you sign up for your own personal account, elsewhere, they will ask you to put up the initial margin. That has nothing to do with the day trading margin that you need to have in the future in order to maintain a day trading position open, right? So initial margin versus maintenance margin for like swings versus day trading margin, they are all very much connected, right? So just be careful, saying things like, oh, it's better if you trade your own cash. because people have traded their own cash. And the reason why these prop firms exist is because people lost everything trading their own. Just remember that whenever you blow up your XFA with even 2K balance, in your own account, there will be 2K of your own real capital, not the $49 that you paid as an entry fee to gain the leverage of 2K, okay? So even with all the issues, even with all the rules and everything, online prop firms are still the best way to mitigate risk to your kids' college fund. Like, bar none, right? So whoever tells people, just go trade your own money. Like, I actually heard one of the big influencers one time, not going to mention his name, but he does have some initials in there. We all know. But yeah, he was saying, yeah, don't go prop firms. Just trade your own, put your own 2K. As if people can keep putting their own 2K over and over and over and over. And this is your typical person who is, pretty well off in life and doesn't actually understand that 2K is a lot of money for a lot of people. Okay? You can't tell people to do that. Because $49 to get 2K leverage is affordable for most. Most, not everybody, but most. 2K at a time to make all the same mistakes that you're going to do at an XFA or any evaluation account, and then doing it over and over and over while you learn, it mounts up to a hell of a lot of cash over time. And then if you have a slight problem controlling yourself, and you keep putting up 2K, that suddenly becomes 10K, 20K, 50K, and then you're divorcing. Why? Because the wife, the spouse, the partner will not stand for it anymore, right? But you spend $49 or even $200, $250, doesn't matter. That's still like the 10th of the amount that you would otherwise spend learning, yeah? So until you're like a consistent trader, consistently profitable trader, and until you're really well off, right? So we're talking having all of your savings, enough for 2-3 years of all the bills, including your kids' school, including your mortgage payments, including all your bills. Don't even think about opening personal accounts, because you will regret it. Like that, there's just no other way around it. There's only a very few individuals that I've met in my life, and I can count them on one finger, on one hand, not one finger. Count them on one finger. I can count them on one hand, where they are super unusual individuals that already have that naturally high self-discipline because of what they are doing in the other parts of their life. So they're usually high-level athletes, they are doctors, they are in disciplines that immediately requires you to have full self-composure in a very highly stressful situations at a competitive level, right? That's a transferable skill that you can absolutely use in trading. But if you don't have that, which let's admit it, most people won't have that, you probably have about 7 to 10 years of learning about yourself, the strategy, and the markets before you can call yourself consistently profitable. But that's not to say that you won't get a few payouts out on that journey from a prop firm. But you will absolutely not have that if you just go down plowing your own cash into personal accounts because you're pissed off at prop firm rule changes. It's like, come on. So mitigate the risk. And yes, nobody's happy about the rule changes, but that's what you have YOLOers to thank for that, and people who are trying to game the system. So if nobody tried to game the system, and if humankind was always fair, we wouldn't need rules, because everybody would be behaving themselves. But there's always people trying to cut corners. There's always people trying to find an easier way, and the rest of us have to pay for it. That's how it is. Just like when at my gym, we had a perfectly amazing sauna where you could pour your own water onto the coals, right? Until one doofus decided to pour the water while standing directly over it, causing burns to his face. And then they decided that now nobody has enough, half a brain or 3 brain cells to not stand over the steam, and therefore they shut the coals behind a non-accessible wooden wall so that nobody can pour water on the coals. It's the same situation, right? So now we're all paying for that that one person in like 25 years that I've been going to the same gym who has ruined it for everybody else. Same situation, right? Let's see. I'm just reading chat now. Yeah, Desmond is right. Use profit from prop to trade your own and right leverage. Continue prop trading. That's what I do, right? And most thank you, Elvis. Thank you. Yes, I realize my mistake. But I'm glad you caught that I can count on one finger. Yeah, it's why we can't have nice things. Yeah, Anne Marie's right. Yeah, so I'm just trying to catch up. And Flash Golden, and our grandparents dress way better. Yeah, I mean, my grandparents were always, my granddad was always, now that you mention it, because I never knew my dad's father, but I knew my mom's, and he always had a tie and a suit. Now that I think about it, why was he wearing a tie and a suit when he was retired for like 30 years? Yeah. Soft, yeah, I agree, the world has gone soft. But yeah, I use, I trade options a lot, or reasonable amount. I'm not like an end of day sort of 0DT person, but, I will always have some kind of an options trade going. And you can't generally trade options. There used to be one firm back in the day called Maverick that, I don't know if they still exist, but they worked on an old style model where you put up a collateral of 5 to 10K, and then you have to go through a course with them before they will unleash you onto their options trading for real. So you do get more leverage for the $5,000 because you can trade, options there were no micros back then, and even now there's only like a couple of firms where you have micros for real. But generally, you needed to put up a collateral of 5-10K, sometimes more. And then if you messed that up, and you didn't manage to make alpha, then you would have to pay a lot more to come back. We're talking 20-30 grand to regain the leverage, right? And now people are complaining about, oh yeah, back to funded is $700-800. It's like, boo-hoo. It's like, that's cheap. We're talking about the financial industry, and somehow prop firms across the board, they've made it much, much cheaper as an entry level skill. But yeah, doing both, trading your personal, trading your prop, is the ultimate. It's the ultimate diversification and mitigation of risk. Absolutely. So 100% we support. MP says it all the time as well. The goal is that you someday trade both. You trade your own and you trade ours. And, I get the question, why do you still do prop firms? Because on an intraday level, I want to mitigate risk. So if I get into a drawdown that lasts for three months, I don't want that to come out of my own pocket. I want that to come out of prop, where I've earned stuff through performance previously, and they could absorb some of that risk, right? And, I also have a problem with my health, so sometimes my brain doesn't work very well, right? So only recently I realized I can start tracking like 2 and 3 different things again at the same time. And that was very difficult for me for especially in the last 3 years. So, we all have our challenges. We all are learning to navigate things. And there we go. Gold back in range. Yeah. Anyways, kids, we've got another 10 minutes or so, 15 minutes to hang together. You will see me for group coaching. But yeah, I think MP is coming on to fast markets. So if you got anything to ask him, that would be the right time. Oh, and yes, so tomorrow, if everything goes well, I will be running this show at a new time, which will be 11:30 a.m. Central, rather than, 11:30 a.m. GMT, which is 5:30 a.m. Central. And then I will be running it until 7 a.m. Central, and then they're going straight into the opening call. So finally, we're going to be moving it. Didn't get the message that things have gone wrong, so I'm assuming that it's going to be announced today. So keep your eyes peeled for that announcement during the main daytime show. And then we can actually start looking at the LME Open rather than watching paint dry, which is the case most days for metals. I will still be covering energies and metals, but it will be pretty much a metals focused show because we have the London Metal Exchange opening literally like 10 minutes after I start the stream, so we can anchor that VWAP to the LME, which is something I like to do. And I can never really talk about this because I'm like, well, yeah, I will anchor the VWAP sometime in the future, but you will be able to see me do it. And also at that time, we frequently get the wicks below Asia lows, and they provide setups that, those levels provide setups that are very, very malleable to that time of day. Just pre-COMEX, looking for that reversal before the madness begins, and then, skimming quite a few ticks well before the exchange opens, but making sure that the increased volume from the LME Open is in our favor. So whenever tape is slow, I don't find it useful to read it. It's like, what are you reading? Nothing. One bubble appearing every 15 seconds. There's no flow to it. It's very difficult. There's no sequential events that we can read properly. And, slow tape is really quite challenging in general. Topstep is here to make profit. Who isn't? Topstep is not a charity, man. It's a financial service. So saying that just tells me that you somehow think that all businesses should be not serving the community to fill a need and make money, of course, but that we should all be charities. Is that what's happening here? Topstep is here to make profit. Of course they are. They're a financial service. So it's like that argument, just Topstep wants to make money. Don't you? Isn't that your motivation too? Like, why are you with Topstep? To not make money? We're all here to make money. Guess what? Money makes the world go round, yeah? Yes, we're here to make money, but we're also here to provide a service. Amazon, they're there to make money as well. But do they provide a service that was very much filling a need? They started out as a bloody bookstore, for Christ's sakes, and now they've taken over the world. Why? Because they sell everything online. They've put like a complete wrench in the works for all of the governmental mailing services, like the Royal Mail. They're suffering because Amazon is better. Why? Because they do overnight delivery. They don't have weekends. And they don't give monkeys if they're going to deliver something at 9 p.m. at night. And that prompted a change in the governmental services to do better as well, rather than to still, hold on to your package even though you paid for first-class delivery. And they're like, we just can't be bothered to deliver it today because we are on strike. It's like, well, great, keep protesting while Amazon is taking all of your business. So, it's the same thing. Any business, when you look at it from a bird's eye view, what do? They provide a service that is much needed for that particular niche, and they want to make money, right? If you want to be Mother Teresa, this is not the industry for you, okay? We're all here to make money. Newsflash. Amanda says, with the prop game that's around nowadays, if you can learn a profitable strategy and meta risk proper, it's much easier to use prop to bank and scale, which is what prop was always about, to scale your own capital. It was never there to let me be undisciplined and then not scale. No, it's there to provide a learning environment that is cheaper, and now it's never been cheaper than today. But it is also there to help you scale the capital that you may not have. Or even if you have it, it's there to mitigate risk. So, why would anyone want to spend their own cash to test a strategy, even if they're profitable, right? The profitability is not a linear curve. It's not like, now I'm consistently profitable, now we'll never, ever, ever have a drawdown. You will have drawdown periods. And in fact, I bet a lot of equity traders are having drawdown periods now because we stopped trending in the equities. That's a market state condition. And now everybody is in this learning pattern. But what do you see in chat? Price action is shit. This price action sucks. This price action is this. How about you don't blame price action, but instead try and get better in the new market conditions? I am actually pretty strict when it comes to excuses in any line of work, but in this industry especially, where people are blaming something else. It's like, no, the price action doesn't suck. You're just not good at this price action. How about that? How about we stop being victims for a second and then go, actually, this is a great opportunity for me to learn range trading. Awesome. Let me see where I suck. Where I suck, not the market, right? And that's how you develop. That's how you grow. That's how you learn. So, I might be jokey, nice, smiley, everything. But when somebody comes to me with excuses, I will shut that down, immediately. And this is where some people don't like that. Some people are like, oh, but Dee, you're not very nice. No, I'm not being rude. I'm just telling you like it is. And truth hurts sometimes. But, tough love. Sometimes we need to hear it in order to push past some of our limitations that maybe our self-limiting beliefs have set upon us. So instead of going, this market environment is terrible, well, you can always move away from that product. There's other things you can trade. You don't have to stare at NQ watching paint and dry and ES being ultra slow whilst it's bouncing in a range. You can go learn other things. Again, it's an opportunity to grow. Always look at a challenge. You can always look at it in two ways, right? You can wallow in the change of conditions, whatever it is, not just in the markets, but also in life, right? Your conditions change of your life and, your situation or whatever. You can look at it as like, poor me, right? Poor me. Oh my God, why does this always happen to me? Typical thing you will hear a lot of victimhood mentality people say. But for those who are fighters, they will go, okay, so not ideal, but let me see what I can do about this. And sometimes it's at the very extreme. I had a friend who had an abusive husband, and he kicked her out on Christmas Day with a child. Child was 4 years old, and she was left with nothing overnight. Where is she now? She was a photographer, but now has a successful wedding planning business, and she's never done better in life. What was the kick up the arse? The day when she got kicked out of the house. Terrible situation, right? Awful situation. But in the long run, it was actually probably the best thing that the guy could have done. So she got rid of the abuser, she started her own business, and she flourished. Was it easy? No. Did she call herself a victim at any one point? Absolutely not. She's a fighter. Absolutely not. Even when it was happening, she's like, I'll get through this. It's fine. I can do it. Never once did she crumble and say, oh, why did this always happen to me? No. Don't give up, okay? Change your mindset. Change whatever you need to change. But trading is not for the weak. I can tell you that now. If you are getting upset about a loss, or boohoo, what are you, 3-year-old child throwing your toys out of a pram? The trade didn't work out. Oh, big deal. Oh, I blew up a combine. Well, whose fault was that? Oh, it was the market. No, it wasn't the market. It was you not adapting to the market. You blew up a combine. So what? It's a learning opportunity. Let's try not to do it again. What can I change? You see the pattern, right? It's the same situation over and over. Elvis says price action sucks in CL for the last year. Give me back my bigger range from 2015. I agree. I do miss it. But what did I do? I stopped trading CL. I trade RBOB. Elvis, if you don't like CL, you will find that RBOB is very, very similar to CL from 2015. Because I get it. That was my breadwinner. I get it. We all miss it. But do I still trade crude oil? Yes. But I trade it through options. I trade it through straddles. I traded through collecting premiums on range-bound markets. I traded through short calls when we get to the top of the ranges. There is a way, but it's not an intraday trading product. So there's still money to be made there, just not intraday. But therefore, I moved on and I found RBOB and heating oil as the alternative products. Are they thinner? Yes. Does RBOB move 500 ticks in a day? Yes. At quieter times, does it still move 300? Yes. How much did crude oil move at its heyday? 250 to 300. What were the quieter days? 150. What's the big day these days on CL? 150. So it's an entirely different market. And I agree, it sucks intraday. Like you start something and it never finishes. It's very range bound. It's very slow. You're lucky if you can like bank 20, 30 ticks from it. And that is just not what suits my style of trading. Me, I need 200, 250, 300, up to about 500, 600 ticks of movement. Otherwise, it's difficult. And whenever that happens, I just move on. I don't dwell on it. I don't go, oh, boo-hoo, why aren't you moving? Can you just move for me? What is going on? I just move on. There's other things to trade. Use it as an opportunity to develop skills in other asset classes. Hey, trade lean hogs, trade ags, trade something else. If you don't like metals, it's too much risk. Trade soybeans. I don't know, corn. That moves seasonally, and when it moves, right? Natural gas. We're just finishing up the seasonality of natural gas at the moment. It's also in rollover, so I'm not touching that. But yeah, look at all these products that we can trade. There will be something for everyone. Superboda says Topstep isn't losing money, they're just getting too greedy and the mass exodus of traders only. No, the mass exodus of traders proves the fragile nature of traders. And what's happened here is that we got used to the gravy train, guys. First of all, payouts from Sim. What kind of Twilight Zone is that? But hey, let's put that aside for a minute. We have now trained this whole new generation of traders to not even know what happens if you're really profitable. I kid you not, when the whole rule change started, we had somebody in here asking the following question. But Dee, if everybody was trading professionally and profitably, where would they trade if the prop firms weren't around? And I was like, the live market? What kind of a question is that? But it tells you what it does tell us. It tells us the mentality of the today trader who are only used to prop firms. They're used to multiple trading accounts, multiplying their positions, trading in sim and sim alone, never getting to live, not actually knowing how the live executions even look in reality, because it's very different, and then complaining that the gravy train has ended. And this is all it is, right? It was an outlier in my 19-year career to have payouts from Sim, and I promise you if any regulations come in, because many people are calling for it, the first thing that the regulations are going to say is stop this payout from Sim nonsense. So the gravy train is about to end even more if that comes into consideration. So be careful what you wish for. Be careful what you wish for, because we still have it good. You can still take payouts from Sim. That was never a thing. I always say, go to M Futures, open up a demo account, rack up 150 grand's worth of payout or 150 grand's worth of balance in the demo, then go to CEO Dan Culp and say, Dan, can you pay me out 100 grand or at least 20% of that? They're going to be like, what have you been smoking today? Thank you. That's what we have in prop. We have payouts from demo accounts. Like, just think about how amazingly ridiculous that is, and how amazing it is that we have that. So any sort of idea that that's somehow real money, it is ultimately proving your performance so that the company can place money behind you. And we had that in the old style prop firms as well, except you didn't get payouts from SIM. You would just stayed on a SIM for a month, they would crunch the numbers and then decide how much money they're going to allocate to you. So for those of us who have been in the industry for a long time, we remember that. And even with that, a lot of prop firms still wanted you to put at least 5 to 10K collateral. You lose that, you don't get another try. You don't get to get another simulation and then go through it. No, they just go, okay, let's talk. And they would take the trader into the office and they would go, thank you, pack your bags, pleasure doing business with you, goodbye. There was no second tries, third tries, 100th try. And that's also the reason why a lot of us who have come from that side of things are able to hold on to accounts for so long, because we're used to much harsher conditions that we have now. Now you can try again and again and again and again. It's like, where does it end, man? Like, when do we actually get disciplined and can hold on to a single account for longer than 2-3 weeks? But, you know, the industry is still changing. They're still finding their ways. It's grown exponentially. And some shifts will evidently happen to both protect the firm's cash flow and to also make sure that people are not gaming the system. And just like my little analogy of the guy who poured steam in the steam room all over himself because he didn't have 2 brain cells to work with, and that caused all the rest of us to not have access to control over the coals in the steam room. In the same way, the YOLOers have caused the prop firms to tighten up rules. Do I blame them? No, but, you know, do I like it? Well, I'm a trader. Obviously, I don't like it. I want as much cash as possible, just like you guys. But it is what it is. And it is their cash, and it is their rules. So whilst I can understand how angry people are, they're going elsewhere. I've looked at the rules of other firms. They're not nearly as favorable still as the Topstep rules. So if you want to go and taste what it looks like when you need to go through an extended period of torture before you even get a payout, whereas having clear rules and very low incidence of payout denials across the board, then you will understand that this is not as bad as it seems. So again, I think there's a lot of bruised egos. They're like, I worked so hard in my demo account. Great. So people who have practiced on the demo account with futures, they've also worked very hard, but they're not going to get squat for it. Why? Because it's a demo. Whereas we still are giving people 20%. And also, look, people are angry, so they're not hearing stuff. That interview with MP and Kevin, they did say 20% is the baseline. We just needed to have a base. It is still possible we will give more to people that we think are consistent enough to deserve it. So it's still up for the discretion of the risk team whether they're going to give you more money. So it's not like 20% do or die. 20% as a baseline, but if you've grinded it out for 3 months in your XFA and you're very consistent, your variance is low, your curve is super smooth, you will get more capital. Probably not 100%, because that's, again, I think that's a little bit too generous, frankly. And the whole business of having, XFAs and alive like we used to, I thought that was hilarious. I was like, what is this? Are they just giving money away now? Like, what's happening here? And I couldn't understand why they were doing it, frankly. So now we're coming a little bit closer to what I imagine will be the future of prop. And I do hope that the regulations, and if any come in for the online prop firms, are not just basically no SIM payouts, everybody has to be in live, we want everybody, and I can totally see that coming from the exchange. I totally can. So be careful what you wish for. Again, we still have incredibly favorable rules. Is it a gravy train? Still, sort of, to a smaller degree, but it's still a lot of capital. Like, even if you start with like 10K, that's 10K of real life capital that you can start with. But yes, you will need to grind it out for the first whatever. Oh, but I'm starting over. You might be starting over, but now this is it, right? This is it. And most people are like, oh, I'm going to lose the 20%. So that's the confidence in your skills, that you're going to blow up the initial 20%. Is that what we're working with? Or, you get into an account with a 20% capital and I will blow the rest of the 80. No! The idea is not to blow, right? Is it more difficult? Sure. Guess what? It's trading. It's not like your mom telling you how great you are just because you participated. It's top level game. And again, it comes back to the entire school system that's rewarding people now for mediocrity. And I'm frankly against it. When I was a kid, you didn't win a race. Yeah, whatever, nobody cares, right? You weren't the fastest, you weren't in the top 5. Nobody wanted to give you anything, really. And now we have people who are like, I have a child, they did the race. Everybody got medals. You don't get medals for doing nothing in life, okay? It's not the reality. And you're talking about a financial industry that is purely performance-based. So if you can't perform, naturally, you're not going to get anything. The end. So yeah, you will lose the 80% from the sim part. Is it fair? No, but life isn't fair either. Again, financial services, banking. How difficult is it to go work for a bank? They all want Ivy League people. If you're not Ivy League, they won't even give you an interview. I know, I worked in IT recruitment. They wouldn't even get a sniff at anybody who wasn't from a top level university. Is that fair? No, but that's what it is. So if you don't like that, perhaps this industry isn't for you. I don't know. So consider that. And, I do say that with kindness, because maybe you don't want to be wasting your life on something that is inherently against the personality that you're trying to project, right? And that's okay. It doesn't have to be bad. It doesn't have to be bad. But as a trader, you have to kiss a lot of frogs on your journey. And ultimately you find something that works, and ultimately, hopefully, with enough stubbornness and persistence, you will keep doing that. And then you get to a beautiful equilibrium where profitability and not blowing up accounts is just a way of life, and you stop stressing, and the FOMO is not a thing anymore. And you are able to hold on to accounts for an indefinite amount of time. Why? Because your risk model and your MAE and your drawdown, you're aware of it and you can work around it. Okay? So again, I'm going to remind everybody, let's all be a lot more positive as we carry on. And let's all just still be grateful that we still have prop firms, we can still take sim payouts, and we can still have some live capital towards the future of longevity and consistency eventually, right? It's not easy, but it is what it is. It's life. I'm gonna end it on this rant. I will see you all tomorrow, what will hopefully be the new time, so keep your eyes peeled on the main broadcast. Again, I didn't get any messages that it's not happening, so I will assume that the time change is going through. We may even have a new name, but it's going to be the same show, same levels, same everything. This was the Eurotrade. I'm Marcus Stalker D, and I will see you a little bit later for group coaching. Take care.